Hey guys, Dave Keller here with StockCharts.com, and welcome to our latest edition of Behind the Charts. Here in Season 2, we're sitting down with some of the top technical analysts, strategists, traders, money managers we could find, and learning the story behind the charts, what sort of got them involved, their early mentors, lessons that they've learned along the way. Today, we're featuring a conversation with one of my former colleagues from Fidelity, Mark Dibble. Mark is one of the technical analysts at Fidelity Investments in Boston. My time with that team was fantastic. Mark will share with you stories about the Fidelity chart room, the chairman of Fidelity, his commitment to technical analysis, his early days at Cowen Co, working with people like Justin Mamus and Rick Aker. And if you don't know those guys, you will after this conversation with Mark. Mark is honestly one of the nicest people I've ever had a chance to work with, and he's also one of the best pure stock pickers I've ever known. Here's my conversation with Mark Dibble.
So Mark, it is fantastic to sit down with you virtually with the virtual Fidelity chart room in the background, which is fantastic to see. Brings back many, many happy memories, I think probably for both of us.
Absolutely. It's great to be here. And your listeners should know that you managed this space for 8 or so years. So
I have very fond memories of a lot of that, and working with you and others on the team is probably the top part of that. The chart room would be below that in terms of things I miss, but I do miss going through that space with you and others for sure. So it is awesome to sit down with you. The goal of this show is to just help people understand the backgrounds behind some of the top performers in our industry. And when I thought of people to feature this season, you were sort of top of my list as someone I've respected for a great deal, and as you mentioned, enjoyed so much getting to work with you. Can you start us at the beginning? Where are you from originally?
Yeah, so I'm a New England boy. Actually, I was born in Newburgh, New York, but as a kid, we moved to Central Connecticut. I went to college in Connecticut, did 10 years in New York on the south side, mostly at Morgan Stanley. And I've been in Boston, Fidelity for 28 years.
Wow. And what was your introduction to the financial markets? Was it through school into the industry? What was that first introduction to the world of equity investing?
Yeah, it was actually a friend of my dad's who worked for Sanford Bernstein and then Cowen and Company. And he used to visit us on weekends and tell stories about the stock market investing. So I was hooked at a very young age, and he helped me get an internship at Cowen Company. I had three summers of working there as a summer employee.
And at Cowen, I know you worked with names that people should know, and I hope they do after this interview. Talk about some of your early mentors, maybe at your time at Cowen, that sort of helped shape you into the technical analyst that you are now.
Yeah, so my first job was actually working in the library, filing corporate documents, which was not terribly fun. And this is before the internet, so lots of paper cuts. The middle folders, in particular, were terrible. So I actually interjected myself into research by filling in for people, admins, when they were on summer vacation, and I kind of made the rounds at Cowen and Company. Helping the quant, the technician on the fundamental side, physically assembling reports and mailing them to clients, putting labels on envelopes. So I just had kind of an affinity to technical analysis. Yeah. I was always kind of the skinny kid who didn't do team sports. So there's some kind of a parallel with that, and being a technical analyst, kind of being a little bit more contrary and not doing what all the other kids wanted to do.
Right. And how did you learn technical analysis? How was it that you actually were introduced to the toolkit?
We was working for Cowen's technical analyst as an administrative assistant and kind of a junior chartist. We didn't have computers back then. We had Quotron machines, and the charts were kept by hand. We also used the Mansfield charts and the William O'Neill charts, which your older listeners will remember, but it was very much of a hard copy world.
And who was the technical analyst that you're working with there?
A guy named Rick Aker, who his primary toolkit was point and figure. So I did point and figure charts by hand, blue pen up, red pen down.
Wow. Interesting. When I think of you, though, and I know your work probably better than most, I don't think of you as a point and figure guy. Was it Did you become disillusioned from that at some point, or was it just finding other tools in the?
I don't have a good answer for that. I'm kind of driven to log scale. I guess you could do log scale, point and figure. I think you probably know that from your Bloomberg days.
Right.
I must say that there was a discipline of going through like 500 pages of point and figure charts every day after the close and filling them in. I think Justin Mamus kind of, it was very much of a rote thing, where it's kind of the charts burned on your brain because you flip the page every day.
Yeah, you're still scarred from the manual process of updating the X's and O's. Perhaps
I had to get glasses when I about 6 months in.
Now, you mentioned Justin Mamus earlier in this series. We talked with Helene Meisler, who I think overlapped with you to some degree,
yes.
or had a similar background at Cowen. Did you overlap at all with Helene or with Justin Mamus when you were at Cowen?
Helene, I did.
Okay.
She was working with the sales team, was just around the corner at One Battery Park Plaza in New York. Justin came in after Rick Aker and I left from Morgan Stanley. So I never worked with Justin, but I certainly knew him and was actually a client of his for many years.
I was going to say, I remember you telling me about and occasionally sharing some of his research later in his career. This is probably many years after that. I remember talking with you about it. So when you think about that, your experiences, what year was this about when you were at Cowen, sort of learning the craft from Richard Aker?
I was a summer employee, 80, 81, 82, and then a full-time employee the fall of 83. But we left Cowen for Morgan Stanley about 6 months later, so I wasn't really at Cowen as a full-time employee for very long.
But the chart of the Mark Dibble career really starts at the 1983 Dow above 1,000 sort of moment.
I know,
like, right?
If I got into my father's, metal bending business, my life might have been a little different.
So when you think about, I often think about my start in the industry, which is in June of 2000. So I learned technical analysis when pretty much everything that had been working stopped working, and growthy technology, names that had been just vertical just turned lower, and it was a very challenging period. You learned technical analysis really, I guess going into 82 low, which was certainly challenging, but then really seeing a raging bull market after that. How were those early formative market experiences? How did they impact your start in the industry, would you say?
Well, it's interesting. You make a good point. It's like our start points were kind of like the opposite of each other. And when I got in the business, the market had been in a trading range from roughly 1968 to the 82 low. So the practitioners of the day were used to mean reversion and playing trading ranges and getting themes right. It wasn't like a big buy and hold and stay with the leadership forever. So my memory is that there were a lot of like oscillators were very popular, MACD, RSI, that kind of thing. And maybe less so today. But I guess the other big difference is that, we didn't have computers, so doing oscillators without computers is a little hard.
Challenging. Well, you're right. And a lot of those oscillators were really designed in the 70s when it was a time when those made a ton of sense, right?
Yes.
Interesting. So then you were at Morgan Stanley. When was the move from the sell side then to the buy side, joining Fidelity?
It was the spring of 94. So I was at Morgan Stanley for roughly 10 years, and I've been at Fidelity since 94.
So another sort of challenging market moment, sort of that mid 90s period before the late 90s in the bull market, I guess the next big leg higher in the bull market. Talk about that transition from, being on the sell side to being on the buy side. What was that experience like for you? Was that an easy transition, or were there surprises there in that transition?
Well, a lot of this was luck. I didn't know in 94 that the sell side would be losing power and the buy side gaining, and that was just lucky. I guess one of the big differences is that you don't have to kind of prove something every day on the buy side. You just have to kind of like it's more of a process. It's less about like getting reports out the door and being current on everything.
Right. And now tell me about this. When you get to the late sort of 90s, early 2000, and not to jump too much into the current market, but in the notes that you shared with me earlier, you talked about potential blow off tops and things like IT, clean energy, things that have had incredible runs, right now that feel like certainly starting to roll over. The FANG stocks starting to roll over. I'm reading a book right now called Bull by Maggie Mahar, which talks about the 1982 to 2004 period and just kind of characterizing that bull market. What was your experience, sort of the late 90s, early 2000, that rotation from secular bull to secular bear? Do you think back now and think of that as a difficult period, as a growth period, as a challenging period? How do you think of it now?
So we don't do much market timing at Fidelity. We generally are fully, I'm saying that, I know you know that, but maybe some of your listeners won't know that.
Sure.
So my job is primarily working with the portfolio managers of equity mutual funds that are fully invested all the time. So it's kind of it's a relative strength game. So if the market's going to go down 30%, if you go down 20%, that's a good thing. Your mother may not think it's a good thing, but but that's the game we play. And so the dot-com bust was it was a lot easier to generate relative strength in that because there were so many things mean reverting the other way. The breadth index actually went up from the peak in the NASDAQ in March of 2000 to the rest of the bear market. Part of that was probably decimalization because the threshold for an advance was a lot lower than the prior 100 years where it was 12.5 cents. So there were lots of ways you could win in the relative game on the way down as the dot-com bubble was deflated. The financial crisis there was nowhere to hide other than bonds and cash. So that was a very different thing.
It's funny. I was familiar with relative strength before joining Fidelity in 2008. I used it way more than I ever had before once I arrived up in Boston. And you and others taught me very much the value of having relative strength on every single chart I ever brought up, which I still do to this day on my show. It's always, I think that was beaten into me pretty quickly from my time there. When you think back and again, you've had an incredibly successful career, Mark, by any measure in technical analysis. When you think back, give us an example of a mistake that taught you the most over that career.
I think losing money is always much more of a learning experience than getting it right, making money. So when I was at Cowen as a summer employee, they were really bullish on like a mid-cap technology stock. It was called Kenilworth Systems. And of course, I went all in because that was the thing to do. And it ended up being a fraud. And I think I lost like 70% in it. And this is before I was doing the technical thing. I was just in a rotation before I got to technical. And I think if I were looking at charts real time back then and kind of knew what I was doing, hopefully it wouldn't have been a 70% loss. The other mistake that comes to mind, and I think young people are probably more prone to doing this than older people like me, is confusing complexity with sophistication. That is adding a lot of other indicators and things to something to make it look complicated, thinking that that's a more sophisticated approach or toolkit. I've actually probably given up, dropped more indicators than I've gained. Certainly, definitely decades of doing it. My toolkit's actually shockingly simple.
Right. I love that quote. Don't confuse complexity with sophistication. I will use that and credit you for that one.
Thank you.
Generously. That's a great one. So besides that, do you have any other favorite quote or saying? I mean, there's so many to describe market events and market truisms. What's a quote that you find yourself referring to often?
So the big hero at Fidelity is Will Danoff, who's about my age. I just turned 60. He's been running the Contra Fund for 31-ish years and with really great numbers over a very long period of time. So he's a big fan of 3-word messages. And a few I have are markets lead news. And you really saw that in the last year where the cyclical stocks and the economically sensitive stocks were doing way better than the news flow or the perception of the economy.
Sure.
Another one is follow relative strength. We've kind of covered that. Another one is vary your process. So I'm a big believer in, look at the long-term chart and look at the short-term chart. Look at the relative strength chart. So the guy who had a big influence on me was Professor Andrew Lowe at MIT across the river. And he's presented at Fidelity a few times. He's written a bunch of books, including some on technical analysis. But one of his points is that computers are really good at big data sets, but the human mind is really good at pattern recognition. So I think if you vary your process, it's like peeling the onion a different way. It's like there's an aha moment where you find a pattern that might be like the money making paradigm.
Those are fantastic. Now, I have to obviously point out the virtual background, as I mentioned at the introduction, showing the Fidelity chart room in physical form. That is a space that you and you've been able to spend much more time in there than I have. But I will always be thankful for the times I had going through that space with you and others. Talk about that physical repository of market history and what that has meant to you over your career.
Yeah, an old friend and a very seasoned technician, Walter Deemer, who I know you know and maybe you've interviewed already. He's visited a few times and he calls it the cathedral of charts.
That's right.
So the short story is our chairman's grandfather, Edward Johnson II, started the chart room as a hobby when he was a lawyer and the Fidelity Fund was a client of his. And that when he took over the Fidelity Fund, he was into technical analysis and trying new things. And the chart room just kind of grew with time. It's moved around Boston a bunch. We've got chart rooms in other offices throughout the world. And I like to think of Fidelity as like a university. There are lots of different ways of looking at the world. And the three big pillars are fundamental, quant, and technical. And they're kind of sometimes they're in agreement, sometimes they're one's a check on the other, if you will, and it's up to the portfolio manager to get the kind of right mix of research inputs in their investment process. So there's a little bit of everything in the chart room. Most of it is macro in nature, kind of big picture, although most of what we do is, as I said earlier, is stock selection. There's a lot of emphasis on sentiment. This is the, see, I'm going to point the wrong way. That's the markets and media, which is magazine covers on the Dow showing contrary points in time where Time Magazine has made like Jeff Bezos man of the year right at the peak in the Amazon and the .com. So the whole idea is to learn, or most people's tenures is 10, 20 years, and they think they're old hands. But in the chart room, you can learn about what's happened over 200 years of history. The one right behind me here is the Dow 1789 to date. A bunch of different academic studies pasted over to get the Dow before it was started in 1896. Learning about, is your group as a stock picking call or a group weighting call? Something that's lost on young analysts. They don't think of, whether their job should be, stock picking versus, weighting, how much correlation there is in a given group. So I'm always selling the concept of visualization over technical analysis. That is, if you can view whatever your mandate is, and this is true of other walks of life outside of finance, law, medicine, whatever. If you can visualize the problem better, you're probably much more likely to get it right or beat your competition to the right answer.
It's so valuable, and what a fantastic resource. Obviously, when you think about when you're describing your process as essentially as a stock picker, trying to outperform by selecting the right stocks. You've been through a number of different market environments. You've been through secular bulls, secular bears, cyclical bulls, cyclical bears, everything in between, and growth-driven markets, value-driven markets. Is there a particular market environment that you find the most challenging, and why?
Yeah, absolutely. I would say trading ranges with rotation are the hardest ones. So when the public looks at a trading range, they think, oh, that's kind of boring. There's not much happening. But if you're trying to add value in the range and the leadership is changing, we've had a bit of this in the last 6 months or so. That is very frustrating. And you tend to, I think as a technician, you tend to second guess yourself. Like at the upper end of the range, you want to go with what's working at the upper end of the range, and then it mean reverts, and there's a lot of whipsaw action. I kind of draw the analogy to like a V8 engine. At any one time, you've got 4 things going up and 4 things going down. So
it's often how it feels like, I think, to be in the middle of some of those. So maybe an interesting transition to talk about the current market environment. We're recording this sort of early mid-March of 2021. I know there's certain things you can't speak to and certain things you probably can't, but can you give us just a sense, I mean, where you're at with, the fact that we've had the incredible run, growth driven essentially into the third, fourth quarter of last year when there was a real rotation into things like financials and energy. Now you've had FANG stocks testing the bottom of the range and now coming back with a fury here in early March. What is your sense of where we're at in the cycle and where you're seeing things from here?
Yeah, so I find it just astounding that you could take the NASDAQ 100, the Q's down 10 or 12%, while the average stock, or even the S&P, and FANG and those stocks are huge weights in the S&P. I think the S&P drawdown was like 3%. So I think the market is as kind of corrected internally. You had a Dow theory buy signal or confirmation signal a couple of days ago. I haven't been watching the tape today, but I think the S&P is at a new high. So I think that's all really bullish stuff. I think, Ms. Market has done its best to make things complicated and painful, and is resumed the bull trend again.
Now, when I think of you, Mark, obviously I think of you as an exceptionally successful stock picker, and I think your career has demonstrated your ability to be in the right names at the right times overall. If you were looking right now, you mentioned a number of things, technology relative to the S&P, you mentioned Dow theory. If you had one chart right now to follow as sort of a tell on what the market overall was doing, what would it be right now, do you think?
Well, it's funny, when whenever I'm with other technicians or on a conference call with a sell side technician, I always ask them what the most important price in the world is.
Yeah.
I think it's interesting to think about that. I think it's the 10-year yield right now. So in January, I said, well, it could go to 150, thinking that might happen like this fall.
Right.
So it went to 162, and this chart because everyone knows this chart. It's been the yield's been going down since for 40 years, and there's a big congestion point kind of starting at 140, and I guess I'd be surprised if it's just going to cut right through this range and get on the two handle. I think that the contrarian viewpoint here is that the yields might actually be mean reverting or in a range or come back down and test, and that could be a tailwind to some of the big growth stocks that have taken a timeout or a hit. I'm a big sentiment guy. So the sentiment on a lot of the high flyers, like the SaaS names, has really gone 180 degrees since the summer. So my crazy idea is that they might be good here from a contrarian standpoint. And I joke about the setup here at Fidelity. It's called the Fidelity Fat Pitch Chart, which is long-term uptrend, a dislocation short-term, which improves the sentiment. I think a lot of the technology leaders are in that bucket right now.
Mark, this has been fantastic to pick your brain a little bit. Just one last question. For someone just getting started, getting new to technical analysis, trying to learn the toolkit, what words of advice or what recommendations would you give to them to be successful?
Yeah, this is going to sound like patently obvious, but I would look at charts. I get asked this question all the time, young analysts, like make a list of charts you look at, whether it's your coverage or some macro charts, and then vary your process. Look at long-term charts, look at short-term charts, but you got to stick with it. It's like a lot of other disciplines in life, sports. You can't just, you got to look at it a little bit every day to keep your head in the game.
Mark Dibble, this has been fantastic. I miss being around you and others at the mothership there in Boston. But wish you guys well, and thanks again for coming on today.
Thank you, and I'd be glad to come back if you'd like me to.
We'll do it.
Thanks, Dave.
Thanks, Mark.
Okay.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.